If your retirement account says $400,000, there's a good chance you don't actually have $400,000. In some cases, you may only have closer to $300,000. The difference is not the market, it's the accounts you used in the order you take the money out of those accounts. Most retirement advice focuses on how much to save, right? Crush the money away. The IRS, it only cares about how much money you withdraw. And those are not the same conversation. This video is about 4 accounts, what they actually are, how they interact, and the withdrawal sequence that keeps the most money in your hands instead of the government's. Now, before we get into the accounts, I want you to consider something. There's one account on this list that almost nobody is using correctly. It is the only retirement account that gives you a tax advantage on the way in, tax-free growth while it compounds, and tax-free distributions on the way out. 3 tax advantages on a single account. No other retirement vehicle comes close to matching it. Most people today, you use it like a debit card. We're going to get to that one. Here's why I want you to understand these accounts rather than just trust someone else to manage them. The best retirement plans, they come from people who understand the definitions, the products, and their general uses. That knowledge, it doesn't replace your CPA, your financial advisor, your lawyer, or a great tool like Bolden. It makes every one of those relationships better. Every account we cover today sits on a spectrum. On one end, you pay tax now. On the other end, you pay tax later. And on one very specific account, you never pay tax at all. The IRS, it has an opinion about every dollar in every one of those accounts. The question is whether you control when and how the IRS collects, or whether they do at all. That's what this video is really all about. A couple retired last year with $800,000 in their traditional 401k and IRA accounts. They felt secure. Then they sat down with their accountant and they learned that between $150,000 and $200,000 of that balance was never really theirs. It belonged to the IRS. It had always belonged to the IRS. They just hadn't paid the bill yet. The traditional 401k and the traditional IRA, they operate on the same tax logic. Contributions go in pre-tax. You get a tax deduction today. The money grows tax deferred, no tax while it sits in the account. But every dollar that comes out in retirement is taxed as ordinary income, whatever rate applies that year. That deduction on the way in, it's not a gift, it's a deferral. The IRS is a silent partner in every tax-deferred account that you own. The 401k, it comes through an employer. The IRS is the solo version. The self-employed, the small business owner, anyone without an employer plan. It's the same tax logic, different contribution limits. It's the same silent partner. And both accounts share a deadline most people do not see coming. At age 73, for most, required minimum distributions begin RMD. The IRS requires a minimum withdrawal every year, whether you need the money or not. For that couple, with the $800,000 RMDs, it can push them into a higher tax bracket, triggering taxation on Social Security benefits that before they were below the threshold and compound every year they do not act. The RMD is not a problem you solve waiting until 73. It's a problem you solve in the years between retirement and 73. That strategy, how to reduce your RMD before 73, it's the entire focus of our next video. Please subscribe and you won't miss it. Now, 2 colleagues, same salary, same age, same year they started saving. One put every dollar into a traditional 401k. The other split, some traditional, some Roth account. 25 years later, they both retire with $600,000 in their accounts. One pays taxes on every dollar he withdraws for the rest of his life. The other draws from her Roth completely tax-free. Same discipline, same timeline, same balance, different architecture, different outcome. A Roth takes contributions after tax. You pay the tax now at the rate you know, all right? Everything that grows from that point forward comes out in retirement completely tax-free. No taxes on withdrawal. No required minimum distributions on a Roth IRA. Now, the Roth is not automatically better than the traditional account. The traditional account gives you a tax deduction today. Let's give you an example. If you're in a 24% tax bracket and you contribute $10,000, the government effectively just contributed $2,400 of that through your tax savings. That money compounds for decades and only gets taxed when it comes out. If your tax rate in retirement is lower than today, you paid less tax overall than you would have with a Roth. The Roth wins when your rate today is lower than it will be in retirement. Your traditional wins when your rate today is higher. Most people approaching retirement, they're not really quite sure which situation they're in. That's exactly the conversation to have with your CPA, your advisor, again, a tool like Bolden. The real strategy is not choosing between traditional and Roth. The real strategy is building both. So you have options that most people do not have. Here's what it looks like in real dollars. Let's say person A has $600,000 all in a traditional 401k. She needs $50,000 this year. Remember, every dollar comes out taxable. At 22%, she'll pay $11,000 in taxes on that withdrawal. Person B also has $600,000, but it's split between a traditional and a Roth. She also needs $50,000. She takes $35,000 from her traditional account, filling her lower tax brackets deliberately. She takes $15,000 from the Roth, tax-free. Her effective tax on that same $50,000 is closer to $4,000. Same need, same amount, $7,000 difference every year. In a higher income year, Social Security active, an RMD forcing income, a capital gain, she'll draw more heavily from the Roth. Tax-free, no tax bracket impact, no Social Security taxation trigger. The person with only a traditional account, you can't do that. The person with only a Roth gave up decades of pre-tax compounding. The person with both can now manage the IRS instead of the IRS managing them. Quick question before we get to the most important account on this list. Which account holds most of your retirement money right now? Traditional 401k or an IRA? A Roth? Something else entirely? Do me a favor, drop it in the comments. Now, let's get to the account almost nobody is using correctly. Now, a 58-year-old enrolled in a high deductible health plan through her employer. HR told her she was eligible for a health savings account. She had been treating it like a medical spending account, contributing a little, spending it down every year on co-pays, prescriptions. In 5 years, she had contributed roughly $40,000. And she spent nearly all of it. When someone finally showed her how the account can actually work, she kind of went quiet for a moment. Then she said, "Nobody told me that." This is the account I mentioned at the beginning of the video. Pre-tax contributions, tax-free growth, tax-free distributions for qualified medical expenses. 3 tax advantages on a single account. There's not another retirement vehicle that does all three. The HSA is available now only to people enrolled in qualifying high deductible health plans. Contributions are pre-tax, the balance grows tax-free, medical withdrawals are tax-free at any age. Most people think the HSA covers basic medical expenses. The actual list is much longer. Doctor visits, prescriptions, lab work, surgery, dental care, cleanings, fillings, crowns, dentures, vision, glasses, contact lenses, eye exams, hearing aids, and the batteries to run them. For someone over 60, a quality set of hearing aids can run $3,000 to $6,000. Every dollar of that paid from the HSA is tax-free. Long-term care insurance premiums up to the limits the IRS sets. And after you turn 65, Medicare Part B premiums, Medicare Part D premiums. Look, the average retiree pays over $170 a month in Part B premiums alone. Over 10 years, that's more than $20,000. Every dollar payable from your HSA tax-free. What the HSA cannot pay for is Medigap supplemental premiums and general wellness expenses that aren't tied specifically to a diagnosed condition. Now, here's the strategy I want you to take away from this entire video. You don't have to spend your HSA on medical expenses as they occur. Pay your current medical expenses out of your pocket. Now, again, if you can, let the HSA just compound tax-free and keep every receipt for every qualified medical expense you pay out of pocket. Why? Because there's no time limit on reimbursement. Now, hear me that again. There is no time limit on reimbursement. So what does that mean? Here's what that looks like in real dollars using the 2026 contribution limits. Let's use an example. You're 58 years old. You're on a family high deductible plan. You contribute the 2026 family maximum plus the over 55 catch-up provision. It's roughly $9,550 per year. You invest it rather than just spending it down. Over 7 years, before Medicare at 65, at a conservative 6% return, that grows to approximately $85,000. During those same 7 years, let's call it, you paid $24,000 in out-of-pocket medical expenses, but you kept every receipt. At 65, you submit those receipts and reimburse yourself $24,000 from the HSA, tax-free. The remaining $61,000 continues to grow tax-free for future medical expenses. You just created $24,000 in tax-free income from expenses you already paid years ago. That's a strategy almost nobody is using. The moment now Medicare Part A activates, HSA contributions have to stop. If you're eligible right now and not maximizing it, every year you wait is compounding. Guess what? You're not going to get that time back, but the account does not stop working at 65. After 65, HSA funds can be used for any expense, not just medical. Non-medical withdrawals are taxed as ordinary income, the same as a traditional IRA, but medical withdrawals remain completely tax-free forever. A fully funded HSA is the most tax-efficient way to pay for your largest retirement expense. And the HSA is the only account built specifically for that expense. Now, let's talk about the withdrawal sequence. You have 4 accounts. Account 1, the tax-deferred bucket, your 401k and IRA. Every dollar out is taxable. Account 2, the Roth. Every dollar out is tax-free. Account 3, the HSA. Every qualified medical dollar out is tax-free. Account 4, your taxable accounts, your brokerage account, savings account, already taxed money. The question is no longer how much you have. The question is which account do you touch first and why? The right sequence is not a fixed order. It's a dynamic annual decision based on what your taxable income looks like in that specific year. Account 4 first, taxable accounts, brokerage accounts, savings. They're already taxed. There's no new tax event when you spend them. Account 1, second, but intentionally. In lower income years, draw from traditional accounts to fill the lower tax brackets, and you're doing so deliberately. Account 2, last, the Roth, the most valuable account to preserve because it grows tax-free indefinitely with no RMD requirement. Every year you leave it untouched is another year of tax-free compounding. And account 3, the HSA. Alongside all of this, for every qualified medical expense. So you're never using taxable dollars for healthcare when you have a tax-free source that you can draw from. Now, this is exactly what a tool like Bolden will model for you for your specific situation, your brackets, your Social Security timing, your draw strategy year by year. Look, I'll put a link down in the description. This is the conversation your CPA or financial advisor is equipped to have once you understand the architecture well enough to even have the conversation in the first place. We started with a question. If your retirement account says $400,000, do you actually have $400,000? Here's what you know now that you didn't know at the beginning. The account balance and the retirement balance are not the same number. The difference is determined by which accounts you built, in what proportion, and in what order you draw from them. Most retirement advice focuses on how much you've crushed away, like I said. How much have you saved? The IRS only cares about how much you withdraw. The architecture you build between now and retirement determines which one of you wins that conversation. And that account I mentioned at the beginning, the one with 3 tax advantages that no other retirement vehicle matches, it was the HSA. Most people today, you use it like a medical debit card. The ones using it correctly are building a tax-free compounding account, keeping the receipts for years, reimbursing themselves tax-free, paying Medicare premiums from an account the IRS cannot touch. Look, the Retirement Reality Check at brainflash.com helps you run this across all 4 accounts against your actual numbers. Look, drop your email at brainflash.com. It'll come straight to your inbox. Now, next week, what the IRS actually takes from these accounts, the RMD trap, the Roth conversion strategy, and what taxes do to a retirement plan never built with taxes in mind. Hey, subscribe so you don't miss it. The knowledge is yours. The plan is yours. And do you know what? Nobody will ever care more about your retirement than you will. This is Brain Flash.